From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello, this is the COB, the stuff that you need to know about the day, markets and business. I'm Kyle Rotto and I'm with Danny Accuyer. Danny, looks like a little bit of a softer session perhaps, unwinding some of the gains that we saw yesterday.
Yeah, I'm just having a wee look now. What have we got? Yeah, about 0.4% down. Yeah, pretty directionless really at the end of the day. And just some profit taking pretty much across the board when I looked earlier, with the exception of the utility sector. And let's just check in quickly. Yeah, utilities was the only really green one today. Energy sold off quite a bit, and we'll see when we look at some of the stocks in terms of where the profit taking's been.
Yeah, maybe a bit of a defensive flavour. We did have a few significant risk events today, or at least we're banging them up as being fairly significant. And that takes us to the three themes of the day. First of all, RBA minutes didn't really tell us too much that we didn't know already, but more or less a cue there that things are on pause for now, and they're going to reassess the situation.
Absolutely, they're going to continue to see how all those interest rate rises flow in terms of, because we've still got a lot of mortgages basically still adjusting upwards. So I think the RBA, it was a very close call that they were thinking of actually raising at the last meeting, but pause and reflect, pause and reflect. Meanwhile, China had some quite good GDP numbers, didn't they? They did see, I was chatting with an independent economist, Janu, earlier on, saying that the consumer has picked up, but also the Chinese government has been investing a lot more in infrastructure. So probably not long-term what they want to do, but at the moment they are having to, I suppose, kickstart the economy to get it up to that 5% growth rate.
Now that's a really interesting point too, isn't it? Because one thing I think a lot of Aussie investors anyway have been disappointed with is that, as the leadership there keep telling us, it's going to be more of a consumer-led recovery, which means, a lot less investment in things like infrastructure and construction activity and things that feed into our miners and what have you. But, maybe some good signs there from Chanu, a word on the street, maybe that there could be a little bit of extra stimulus, at least in those crucial areas of the economy. And last but not least, we'll talk a bit of tech as well, because we do have the beginning, I would call it anyway, of some of those tech names reporting in the next couple of days.
Yep, Netflix tonight, and obviously people will be looking for the subscriber numbers there, also looking at how they are going in terms of payments, advertising, all of that. But the big one is probably Tesla. And that comes out on Wednesday night, our time, and people will be very much looking for margins, what's been going on, because they have been price cutting, a lot of competition, particularly softness in the EV markets, both in China and also in the US. So given that some of those stocks have been really good performers, they may be bellwethers to some profit taking as well.
Yeah, definitely. And actually I found out something interesting today from Tony Sycamore, is that Netflix isn't going to be publishing its subscriber figures
isn't
anymore.
It?
No.
Oh, that's right, I forgot about that.
So they're going to be focusing on their revenue instead, and try and shift the focus away from subscriber growth, which basically says that's
good point.
A metric they don't want to emphasise anymore. So we'll have to try and dig through the I suppose, details there to get any kind of sense on what they're actually doing when it comes to subscriber numbers. But no, they want us to focus on revenue, so I learned that one today. But let's get across some of the sectors that we do like to track, and I thought, we'll keep it resource focused just to start with, because we did have that China data, and there wasn't really that much of a response. In fact, if you look at the screen here, Danny, that really it was actually quite flat.
Absolutely, and I believe Singapore and Dalian iron ore futures were up a little bit off China data, but not much flowing in there in terms of the big material stocks. It's pretty much flatlining at the moment.
Yeah, not too exciting. And energy, we'll have a look at that, because it was a laggard in the US last night. We actually saw about a 1.7% drop in the oil price overnight, so that weighed on Wall Street energy. But we're also seeing here some weakness coming through the likes of Woodside, off by almost 3%. The coal players bounced back, but that was after a sell-off to start the week.
Macquarie is flagging a possible change in the resource rent tax for both Santos and Woodside, which may have had some impact there. But you're right, utilities firmer today. The only thing I can suggest, because I haven't picked up on any news, is possibly the lead from overseas. I noticed that some of the utility stocks in the US had been firmer overnight, but I certainly haven't picked up anything.
No, it's just write it off as I don't know, maybe a bit of defensive positioning or something like that going into a couple of days of key event risk. Who knows? But certainly the top performing areas of the market today are those utilities. But well, let's get to the stock of the day. Danny, take us away, because obviously you were hosting again today the call.
Well, I was indeed, with some very bad jokes. So apologies to everyone. But yeah, so. Two guests, basically Joshua and Scott. Neither of them were particularly well disposed towards Pilbara. So Scott just basically doesn't like to invest in commodity stocks, so it was a complete out and out avoid. And Joshua was more inclined towards mineral resources as another stock. As an alternative. So Pilbara really, in spite of the upgrade that we've seen from UBS that has pushed the stock higher today, didn't find any love from our two guests today.
No, Scott Phillips and Joshua Barker here talking about Pilbara Minerals. Here's what they had to say.
Well, I will be controversial, so that's always fun. Mate, I've been a long-term avoider of the lithium sector, and that's not changing today, and it's not changing when it comes to Pilbara. And it comes down to a couple of things, mate, but largely it's very, very difficult with any confidence to forecast the long-term price of any commodity, including lithium. I don't know what happens, and sometimes the too hard pile is a very welcome place. So I'm putting lithium there squarely and fairly. I'm not bearish, not betting against it, but I'm absolutely not betting for it because I have no concept of what the price will be in 3, 5 or 10 years' time. And as an investor, as a long-term investor, if you don't have a view on that, I don't think you have a place investing in lithium.
Yeah, not necessarily bearish on the lithium market, but it has struggled this calendar year anyway. If you do want to be in this space, I think Pilbara is the best place to be in that space. But even just in the ultra short term, it is struggling to significantly go above that $4 mark this year. So I'd just be cautious with it at least.
So a sort of interesting call there. I mean, it was not quite a sell, it wasn't quite a hold. It was just not our cup of tea. We want to avoid it. So perhaps horses for courses there. If you like your Pilbara plays, you're into your commodities, perhaps it's something for you, but those guys, it's not up their alley. But okay, let's get to the view, because systemic risk, we're all talking about it, or at least have been recently. And well, you've brought your wealth of wisdom to the view today. What's it all about?
Yeah, and there's some benefits of growing older because you've seen a few financial crises. So basically, I just refer to long-term capital management was the first big example of systemic risk in financial markets that I lived through. And why I've raised this is there is concern from the likes of the head of the SEC as well as the IMF about the shadow banking system, the non-bank financial intermediaries, which have grown substantially in size. Basically, these are financial institutions, hedge funds, pension funds that don't take in deposits, but can be extremely leveraged. And I guess what I was trying to say is that it's not necessarily, if there is another big risk-off event, we don't always know where it is, but in periods when interest rates rise, things happen. We've seen it in the UK gilt market, we've seen it in the regional banks, and they are flagging just maybe concerns, not saying anything's going to happen, but the leverage in the hedge funds is huge. And I think they're up at, they've quadrupled in size post 2009. So when you combine that with the VIX, which is at a 52-week low over in the US, I guess I was just saying to investors, well, there's a bit of complacency sinking into the US markets.
Yeah, and I was caught off guard a little bit when it came to the VIX overnight. Of course, it can be a read of many different things, and perhaps you can read into it what you will, but 16.
Yeah, 16.
I haven't seen that in a really long time.
Yeah, 16, and also the move's been coming down as well. So, for those people that watch things like the VIX, I think, it's just worth always to be well informed is to be well armed.
And there you go. That's a perfect place to leave that one. But let's get to our guest for the show. And Martin Crabb from Shaw and Partners joins me now. Martin, where should we pick up? I mean, obviously we're just talking about systemic risk, but maybe we'll start with the RBA minutes just for now, because, well, I guess it just rubber stamps what we already knew. Things are on hold, they're pausing, then could hike again. We'll wait and see what the data has to say.
Yeah, there was a hawkish tone to it, which the market didn't like, though. the dollar rallied a little bit and the equity market sold off post those minutes being released. And if you compare the language with the previous month, you can see that this whole idea of cutting, which is what the market was thinking back on the 16th of March, which was after the Silicon Valley Bank. The market was pricing in cuts. We've now moved back to an RBA on hold, but the minutes today basically said we're going to hike again. So I know there's at least a couple of banks that are saying a hike in May. There's a few that are saying a hike in August, but they're basically saying we just wanted to have a bit more of a look at the data. So we've obviously got the CPI number out next week. We've then got maybe some indication from Fair Work Commission about what they're thinking about with minimum wages, which will come through sometime in June. Just to give themselves a bit more time to look at the numbers and household spending, etc. So the ANZ came out with their credit card spending data today, which showed a pretty sharp slowdown, in consumer spending in March, take into account the positioning of Easter versus last year. So I think, a lot of people are now saying, well, okay, they're not going to be cutting rates. They're going to be at least holding them, but probably more leaning towards another hike. So we get to 385 and then we stop.
Interesting. And obviously, if we get a bit of support out of China as well, how did you read those numbers today?
Yeah, look, it's interesting. The viewers may not know, but China doesn't publish economic data for January and February because of Chinese New Year. So you get a whole bunch of data in March. So today we've got retail sales, fixed asset investment, GDP, the whole kit and caboodle for the quarter. And so you kind of had to backfill your model. So GDP itself came up 4.5%, which is above expectations. People look at the composition and said it was very much driven by retail spending, but household savings in China grew 27% this quarter over the previous quarter last year. So it's this kind of story that, people are locked down, they can't spend money, so national savings are going through the roof. So it's interesting that the Chinese government and central banks' goal to get people to spend, whereas in Australia and the US, we're trying to get people to stop spending. But one thing I look at, which is a quote from former Premier Li Keqiang, who said to The Economist magazine in the mid-2000s that he didn't believe the numbers coming out of Beijing because they were man-made. So he looked at rail freight movements, electricity production, and bank credit. And so The Economist came up with an index of those three factors, called it after the former Premier Li Keqiang, up 11% in March. The traffic freight volume's not out for March, so I just used February's number there. But you can see consistently those three measures are all double digit. So official GDP is 4.5, but that measure suggests the economy's a lot faster. That same measure said the slowdown in 2015, 2016 was much bigger than they were saying, which we worked out was true. But you've got those three factors are growing very strongly. So the China bull story is very much intact, and probably one of the reasons the materials sector did a little bit better today than the rest of the market is that, how do you get exposure to China? We've got Treasury Wine and A2 Milk and maybe IDP Education, but it's really the iron ore miners that are the stocks that you buy.
That's interesting. So can we just get that chart back up again? Because you obviously explained the construction of it, but so the way we interpret that is perhaps twofold. One is that obviously it's very, very strong now, but there's base effects that's working off where things were weaker than the published data last year, but that's more or less already known, that's in the past, and now we're working off a lower base, ergo things are better than expected. Is that roughly how do we interpret that?
Yeah, I'm just saying the GDP is understating the strength of growth. I mean, the GDP is a broader measure than those three things. When you think about those three things, they're very industrial in nature. I mean, banking credit just grows 10% to 12% every year in China. It never slows down. But those other two measures are quite volatile, and particularly rail freight. Rail freight, clearly is an indicator of the amount of stuff being moved around the economy. Not as much export-led, whereas something like electricity generation, a lot of that is heating and so forth, but a lot of it's also making steel. Making power for industry. So it's designed to be just a broader measure that's a bit more contemporaneous than the man-made GDP numbers.
So does it infer that the next quarter's GDP numbers are going to be, even stronger? Is it like this is kind of like an indicator saying, well, we've held back some of the growth that's in the economy and we might just shift it into the next quarter? Yeah,
it's suggesting that the official GDP is being understated.
Yeah.
That's what it's suggesting.
Yeah. Massaging.
And I know you've already sort of said it, but by extension of that, you would assume that perhaps the miners or some of those stocks that we keep pointing to as being, well, China sensitive, well, maybe undervalued at these levels, or at least a decent buy?
Yeah, I'm not sure. I mean, we're probably, like most people, a little bit cautious about iron ore being $120 a tonne when there's so much, new production coming on stream over the next few years. And China should be reducing its metal intensity. So yes, its economy can continue to grow, but if they're using more scrap and less, less new steel, then that's going to reduce demand for iron ore over the longer term.
Yeah, I just wanted to touch on the debt ceiling, because that's definitely something that's bubbling up into the mainstream media. So what are you thinking about?
Yeah, look, it's a real sleeper issue. When I was in London in January, that was raised as probably the biggest risk this year to markets, and everyone just went, don't be silly, they just kick it down the road every year. But I think the amount of pain that the Congress went through to elect McCarthy, I think it was 18 votes or something. It was very clear that the Republicans are just not going to kick this down the road anymore. The Democrats want the debt ceiling moved to next year with no conditions on it, and the Republicans have said, no, we want you to stop spending, we want you to start reducing these deficits because they're just getting out of control. So the credit default swap, which is the risk of the US defaulting on its treasury in a year, is about 1%, which is insane, right? It's one of the, it's AAA rated by Moody's, it's AA plus Standard & Poor's. It's about the safest kind of rating you can get for a sovereign, and yet to ensure the debt defaulting this year, it's cost you about 1%. So the credit markets are telling you this is a real issue. There is a chance that some liabilities that are falling due this year, the federal government's not going to be able to pay them. So because of this debt ceiling, so just be careful lending to the US government on a 6-month view. You're gonna, you're in for a rocky road. So I don't think the markets are really pricing that in. In fact, they seem to be ignoring it. But I just think investors should be aware that this is a real issue, and the market's pricing in, problems that could happen. On a, you talked about systemic risk, and we've got a pretty fragile financial system, as what's happened in the past couple of months have showed us. You don't want, concern about a default of the world's biggest detonation thrown in that as well, right?
It's going to make LTCM look like a walk in the park when Russia defaulted, but we won't go there, will we?
No.
Well, so what would the potential investment implications be of that? Obviously, it's one of those very complex situations where there's a variety of outcomes that could materialise. But I mean, is it simply going to be a plumbing issue? Because obviously that's going to mess with the treasury market a fair bit. I mean, it's going to have knock-on effects, obviously, to market liquidity, equity prices more broadly. I mean, is that going to be one of those moments where you're just going to have to really sit to the sidelines and just hope they flesh this thing out?
Markets hate uncertainty, right? So what that measure's telling me is that there is a game of brinkmanship that's going on that's going to come right up to the 11th hour, and it's going to be a Cuban Missile Crisis kind of countdown. And, you hope that they push something through. But if, based on what I'm hearing at the moment, the Republicans are really dug in on they want some spending controls and some measures put in place to reduce the size of these ever burgeoning deficits. That's going to put a lot of pressure on the Democrats to do something about that, rather than just saying, we're going to kick it down the road. So the markets are going to be nervous about it. So as we approach, I think September is probably the drop dead date. As we approach that date, the market's going to get more and more cautious about it. So it's just another risk-off factor. So things like, gold do well in these situations. Perversely, the US dollar is not going to go well because it's probably in the centre of it. But I just think you should be just building a little bit of a risk premium into markets.
Okay, we might have to leave it there.
Yeah, absolutely.
But,
it's a great topic, though.
Cheery note.
Well, cheery note, and I'm sure if it is indeed something that's going to be coming at us like a freight train, we won't. This is not the last time that we'll be talking about it. So, Martin Crabshaw and Partners, thank you so much for your time.
Thank you.
Okay. Well, let's have a bit of a look at what's happening overnight, shall we? And, a few things in Canada, but we were talking about it before. Perhaps US earnings will be the thing to watch.
Yeah, absolutely. Although I do think that Canadian CPI and will be quite interesting what's going on north of the US border, only by virtue of the fact that the Bank of Canada was one of the first to go on pause. So markets may read something into that. But yeah, lots of big bank earnings coming out. Well, not banks, yes, definitely banks. I think we've also got Bank of America, Goldman Sachs, Netflix, and there were a couple of others that I had. Johnson & Johnson coming out and United Airlines as well.
Yeah, there's sort of consumer staples plays will be interesting as well, and United Airlines, like you said, another fascinating one. Okay, well, that's that, and well, we'll keep our eyes peeled. Let's get to those leaders and laggards, shall we? And homing in on the leaders first. What do we got? A blank screen. We've been staring into the abyss.
I think it was Telix.
It was Telix Pharmaceuticals.
Yes,
actually.
I think that was one of the stronger ones today.
Yeah.
Basically, they had a better than expected first quarter report. Oh no, we've got the laggards instead. But look, profit taking coming in there in terms of Lake Resources had a really strong bounce yesterday. Yeah, Paladin. I think I just see a lot of those laggards in terms of rotational. They're up, for a couple of days and then some profit taking coming in. I haven't picked up anything on Star Entertainment.
No, but it was up yesterday as well, we
Yeah,
saw. So
yeah.
it was sort of a swings and roundabouts, but we couldn't really find a good story there as to why
Paladin,
that might have been the case.
people going off uranium for the
Well,
moment.
yeah, well, it's like we were mentioning before. I mean, my background obviously is working for retail brokers, and they call it obviously the funny money sometimes. They call it the dumb money other times. But
Ouch.
in these sorts of in these sorts of environments, the most popular names to trade, Tesla's one of them, obviously, but the lithium plays, uranium plays,
and
gold plays.
Yep.
So you see those kind of moves, especially you were talking before that maybe holiday thinned volumes, like people are looking after their kids rather than at the desk. These things can obviously blow out a little bit. Here we go. Well, there's Telix, and that wasn't because of dumb money by any means. That was actually on a really good result last night, a quarterly update that the company released.
Absolutely, yep, better than expected. And as I mentioned earlier, we've had an upgrade by UBS of Pilbara Minerals, and that's been very supportive of that share price. And maybe Allcom finding some love as well with what UBS has been recommending with Pilbara. A2 Milk, maybe that's riding on the China theme. I'm not 100% sure in terms of why that one is finding some love at the moment. But yet again, we tend to see those lithium players very much falling into the leaders and the laggards most days.
Yeah, every day almost. And at least Pilbara Minerals there was stock of the day. I don't know, maybe the algos were scraping the AusBiz platform and decided to pump that one up towards $4. But of course, you did say that there's a couple of broker upgrades there that, have kept that stock in focus. But let's have a look at the small caps now. Always fun.
Oh la la, that is quite some moves there, isn't it?
Yeah, well, I think that might have
They're
been...
the ERA rights, are they?
I think that might be a typo. That's a fat finger. If we're on a dealing floor, someone would have just been walked out with a brown paper box, I think. But there you go, energy, whatever that is. But coal in the focus as well, very minor, it's heavy. And St. Barbara, interesting, down 10% today it would seem. So that's a fairly significant move.
Peak rare earths off 9%. Andromeda metals, I'm not across that one, off about 9.5% as well.
Indeed. Well, I guess that does do it for another day. We're going to have a lot of news out tonight, US earnings, and a little bit quieter on the macroeconomic calendar, but I think we're going to be kept very, very busy with those US earnings. So, Danny, what do you reckon? Call it a day for another one?
Yes, absolutely. But that was a great chat we had with Martin, and I think that's all for the COB today.
It certainly is. Make sure to catch up on all the news and interviews on our website and app. We'll see you tomorrow morning.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.